Silver plummeted over 17% in 6 hours. $20 billion in market value evaporated while most investors were still calculating yesterday's gains. This represents the most violent single-day move in the white metal since April 2013. The trigger came from one announcement out of Washington that changed everything in the precious metals landscape. Here is exactly what unfolded in one of the most extraordinary trading sessions of the decade. Hours ago, silver was riding all-time highs above $120 per ounce. Investors celebrated record portfolio values. Analysts competed to raise their price targets higher. Social media buzzed with predictions of $150 by summer and $200 by year-end. The momentum appeared unstoppable. Retail traders who had held silver through years of frustration finally tasted victory. The vindication felt complete. Then the selling started. The first wave hit during Asian trading overnight. Prices slipped from 120 to 115. Traders dismissed it as profit-taking, normal consolidation after a record-setting run, nothing to worry about. The second wave arrived during European hours. Silver dropped through 110, then 105. Concern began replacing complacency. By the time New York opened, silver had sliced through the psychologically critical $100 barrier. It fell through that level with barely a pause. At the session low, silver touched $91 per ounce, $29 below the previous day's peak, nearly a quarter of its value, erased, in hours. The leveraged funds experienced what traders euphemistically call a catastrophic event. The ProShares Ultra Silver Fund lost 42% of its value in one trading session. Consider what that means for a moment. Not 42% over a difficult quarter. Not 42% during a bear market year, 42% in hours. Investors who held $100,000 of that fund at yesterday's close watched it become $58,000 before lunch. The iShares Silver Trust, the largest silver-backed ETF in the world with over 14,000 metric tons of physical metal in vaults, dropped 21%. Mining stocks followed the metal lower in brutal fashion. Core mining plunged 14%. First Majestic collapsed 11%. Pan American Silver tumbled. Hecla Mining cratered. Fresnillo, the world's largest primary silver producer headquartered in Mexico City, fell 4%, even as London traders scrambled to assess the full damage across their portfolios. The magnitude of this move demands historical context to fully appreciate. The last time silver experienced this level of single-session violence was April 15, 2013. Market veterans still speak of that day with something approaching reverence. Silver dropped 11%, gold fell 9%. Traders called it the precious metals massacre. Careers ended. Fortunes vanished. The psychological scars took years to heal. But there is a crucial difference between that massacre and today's event. In April 2013, silver was trading around $23 per ounce. Today's crash started from $120. The absolute dollar amount of wealth destroyed in this single session dwarfs anything in modern precious metals history. A percentage decline of similar magnitude from vastly higher price levels means the actual capital loss exceeds previous crashes by multiples. The catalyst for this historic move arrived from an unexpected direction. President Donald Trump announced Friday morning that he would nominate Kevin Warsh to succeed Jerome Powell as chair of the Federal Reserve. The selection concluded months of speculation about the world's most important economic appointment. Markets interpreted this choice immediately. Their interpretation sent precious metals into freefall. Kevin Warsh represents a specific figure in American monetary policy history. He is not a random political appointee. He served on the Federal Reserve Board of Governors from February 2006 until March 2011. He was the youngest governor in Fed history when appointed at 35 years old. During the 2008 global financial crisis that nearly destroyed the world economy, Warsh acted as the primary liaison between the Federal Reserve and Wall Street. He knows these markets with intimate familiarity. He knows the players. He knows how the system operates at its deepest levels. More critically for precious metals investors, Warsh carries a specific reputation on Wall Street. They call him a monetary policy hawk. In Federal Reserve terminology, this designation carries significant meaning. Hawks prioritize fighting inflation over stimulating economic growth. They typically favor higher interest rates even when such policy causes economic pain. Higher rates strengthen the dollar. A stronger dollar crushes commodities priced in dollars. This mechanism explains why gold and silver reacted so violently. The market connected these implications instantly. Traders did not wait for confirmation hearings or policy speeches. They sold first and asked questions later. The dollar index surged 0.3% to 96.56. Precious metals tanked in direct proportion. Analysis emerged within hours. Evercore ISI's vice chairman Krishna Guha published his assessment of market dynamics. His language was unambiguous. "Markets are trading hawkish," he wrote. "The selection should help stabilize the dollar and reduce the risk of extended dollar weakness by challenging what he termed debasement trades." This dynamic explains precisely why gold and silver moved lower so dramatically. But attributing this entire cascade to the Warsh announcement oversimplifies what actually happened. This sell-off had been building beneath the surface for weeks. The pressure was mounting daily. Technical indicators flashed warnings that traders either ignored or could not see through their profits. The market needed only an excuse to release the accumulated tension. The Warsh news provided that excuse. Technical indicators had been screaming warnings. The relative strength index for silver reached extreme overbought territory rarely seen in commodity markets. Gold's RSI hit 90, the highest reading for the precious metal in decades. Technical analysts understand what such extreme readings mean. When indicators reach these levels, corrections become not merely possible but mathematically probable. The question was never whether a correction would occur but when it would arrive. Multiple veteran analysts described recent precious metals action using the same word: broken. Nikki Shields at MKS PAMP, one of the most respected voices in precious metals analysis, pointed to what she called unheard of volatility driven less by physical supply and demand fundamentals than by wild liquidity flows. Her observation deserves consideration. When price moves decouple from physical reality, something unusual is occurring. Maximilian Tomei at Galena Asset Management was even more direct in his assessment. "Fundamentals alone cannot explain a commodity rising 200%, he noted. "The way silver is behaving is exaggerated. It is a series of disconnects." His words captured what many traders sensed but could not articulate. The link between price and value had stretched beyond recognition. This observation leads to a critical question. What created the disconnects? Who was buying so aggressively that fundamental valuation stopped mattering? Understanding this dynamic helps explain both the rally and the crash. The answer involves a collision of powerful forces that rarely coincide simultaneously. Central banks accumulated precious metals throughout 2025 at record pace. Their motivations ranged from inflation hedging to dollar diversification to geopolitical positioning. China's holdings reached all-time highs as Beijing sought alternatives to dollar-dominated reserves. Other central banks followed similar strategies with varying degrees of intensity. Exchange-traded fund inflows reached extraordinary levels. The World Gold Council reported ETF purchases totaling $89 billion during 2025. Retail investors piled into precious metals through platforms ranging from traditional brokerages to smartphone apps. Many were first-time precious metals buyers, attracted by the price momentum they witnessed. Industrial demand provided additional support. Solar panel manufacturing requires substantial silver content, and global photovoltaic installations kept breaking records. Electronics demand increased with each new product generation hitting markets. Electric vehicle production accelerated globally, and these vehicles use silver in numerous components. All these buyers competed for a finite supply of physical metal sitting in vaults and mines around the world. Then, speculative activity accelerated beyond anything analysts had modeled. Call option activity on silver reached historic levels in January. Goldman Sachs noted in a recent analysis that record waves of call purchases mechanically reinforced upward price momentum. The mechanism works as follows. When traders buy call options, market makers who sell those options must purchase underlying assets to hedge their exposure. This creates a reflexive loop where buying begets more buying in a self-reinforcing cycle. The market went parabolic. Silver gained over 50% in January alone before today's crash. Daily moves of 5% became routine. 10% swings barely raised eyebrows. Traders adjusted their expectations upward continuously. $100 silver became not just possible but expected. $150 targets proliferated. Parabolic moves share a common characteristic across all markets throughout financial history. They do not end gradually with a gentle tapering into new trading ranges. They snap. The pressure builds until structural failure occurs. When that failure arrives, it arrives suddenly and with violence. Today represented that moment of structural failure. So, where does silver go from here? This question has divided the financial community into two fiercely opposed camps with irreconcilable views. The bull case starts with fundamentals that have not changed despite today's destruction. Industrial demand keeps growing regardless of investor sentiment. Solar installations break records globally and show no signs of slowing. Electric vehicles require silver in numerous components, and EV production accelerates quarterly. Electronics demand increases with each new product generation entering markets. HSBC projects the structural supply deficit in silver will widen to 1.2 million ounces this year. This is not speculative paper demand. This is physical metal leaving vaults for factories where it will be consumed in manufacturing processes, never to return to the investment market. Central bank buying shows no signs of stopping or even slowing. With the dollar's reserve currency status facing questions from multiple directions and geopolitical alignments shifting, sovereign wealth managers continue diversifying into hard assets. The Warsh appointment may actually accelerate this trend if international markets interpret it as the beginning of a new approach to monetizing American government debt. Foreign central banks watching the dollar's future may increase precious metals allocations as insurance. Even after today's devastating decline, silver remains up over 30% in January alone. The 9-consecutive-month winning streak technically continues. Corrections of this magnitude occurred multiple times during the gold bull market of the 2000s without ending the secular trend. The 2008 crash wiped out gains, yet gold proceeded to reach all-time highs by 2011. Many traders view today's decline as an opportunity to purchase metal they missed during the parabolic phase. The bear case presents an equally compelling counter-argument with historical support. Former JP Morgan chief strategist Marko Kolanovic issued a warning this week that rattled markets before today's crash even occurred. He called for silver to drop to roughly $50 per ounce later this year, half of current prices. His reasoning cuts to the heart of the bull case vulnerabilities. He sees meme traders attempting to take over the market. He sees speculative mania destined to unwind violently. His exact words deserve attention. Silver is not gold, Kolanovic noted. It trades with higher volatility. It responds dramatically to fear and greed cycles. It has a track record of punishing late buyers in ways that gold rarely matches. The white metal's history is littered with the financial wreckage of investors who bought near cycle peaks. History supports his caution with painful precedent. In the late 1970s, gold surged from around $40 to $200. Euphoric buyers piled in near the apparent top, certain they were participating in a generational opportunity. Then gold crashed 50% from those levels. The pain was immense. Portfolios were devastated. Many investors capitulated near the lows, absolutely certain the rally had ended. They were wrong about the secular trend. Gold then rallied to $850 per ounce by January 1980. Those who sold during the 50% correction missed a quadrupling of prices. The psychology was identical to what silver investors may experience today. Kolanovic suggests silver may be setting up an identical psychological trap for a new generation of investors. A 50% correction from current levels would devastate retail sentiment precisely when the secular bull market has more room to run. The shakeout would transfer metal from weak hands to strong hands at exactly the wrong moment for the weak hands. The technical picture offers specific levels to watch in coming sessions. Initial support sits at the $90 to $95 zone. This represents today's lows and forms a psychological floor that traders will monitor closely. Below that level, more critical support falls between $70 and $80 per ounce. This range coincides with late 2025 highs and the 50-day exponential moving average. A decline to these levels would represent an additional 10 to 15% correction from current prices. Resistance has now been clearly established at $110 to $115. The market rejected this zone aggressively during the crash. Any rally attempt must clear this barrier convincingly or risk being sold heavily by traders who bought higher and need to exit positions. The gold-to-silver ratio provides another analytical lens through which to view recent developments. This ratio measures how many ounces of silver equal 1 ounce of gold in market value. The ratio recently approached 31, a level last touched in 2011 during a previous precious metals mania. Standard Chartered's Manpreet Gill notes that when this ratio reaches such extremes, consolidation typically follows. Gold may experience milder consolidation while silver, given its inherent volatility characteristics, could see larger swings in both directions. The nature of today's decline itself invites scrutiny from market structure observers. Gregor Gregerson, founder of precious metals dealer Silver Bullion, observed that normal profit-taking exhibits different characteristics. If large institutional holders wanted to exit positions, they would sell gradually over time to achieve the best possible average prices. What we witnessed instead was a massive drop over a very short period without obvious public drivers. The pattern suggests forced selling, margin liquidation, or other mechanical pressures rather than voluntary profit-taking. Some retail traders have raised questions about the sudden nature of this sell-off. The Wall Street Silver community on Reddit has been actively discussing potential explanations in market mechanics. However, markets this large and liquid typically reflect aggregate decisions from thousands of participants operating across global time zones with different motivations. Attributing moves to any single cause rarely captures the full complexity of what actually occurred. What happens next depends significantly on how the Federal Reserve situation develops over coming weeks and months. Kevin Warsh must still face Senate confirmation before assuming the chair position. This process typically involves hearings before the Senate Banking Committee and a floor vote. Republican Senator Tom Tillis of North Carolina has complicated the timeline. He indicated he will block any Federal Reserve nominees until the Justice Department completes its investigation into actions involving Chairman Powell. This creates uncertainty about when Warsh might actually take the position. If confirmed, Warsh would assume the chair position in May when Jerome Powell's term expires. Between now and then, markets will scrutinize every public statement, every interview, every data point for clues about future monetary policy direction under new leadership. The broader economic picture adds further complexity to the analytical challenge. Friday's producer price index came in hotter than expected, suggesting inflation remains stickier than the Federal Reserve would prefer. Inflation readings above target reduce expectations for aggressive interest rate cuts regardless of who chairs the Fed. Each economic data release will shift market sentiment as traders reprice expectations. For perspective on market positioning dynamics, consider Katie Stove's analysis from British wealth management firm Mattioli Woods. She attributed today's sell-off partly to what she termed a market-wide reassessment of concentration risk. The parallel she drew is instructive for understanding current dynamics. Just as artificial intelligence technology stocks have dominated attention and attracted concentrated capital flows, gold and silver have similarly seen intense positioning. When everyone in a market leans in the same direction simultaneously, even fundamentally sound assets can sell off violently as positions unwind. Crowded trades create their own gravitational forces. This dynamic may actually benefit the long-term bull case despite the short-term pain. Parabolic moves that proceed without correction typically end catastrophically with permanent capital destruction. Periodic shakeouts remove weak holders who panic and allow committed long-term investors to accumulate at better prices. The fundamental drivers of precious metals demand have not changed with a single session's extraordinary price action. Industrial demand will not shrink because silver dropped 17% today. Solar panels still require silver in their construction. Electronics manufacturing still needs silver for conductivity. Electric vehicles still use silver components. This structural demand exists independent of investor sentiment or short-term price movements. Investment demand from central banks follows different logic than retail investor flows. Sovereign wealth managers operate on multi-decade time horizons. A single session's volatility does not alter their strategic calculus in any meaningful way. If anything, lower prices present accumulation opportunities for institutions with mandates to diversify reserves away from dollar-denominated assets. The retail investment community faces a psychological test in coming days and weeks. Many investors bought silver during the 2025 rally and still hold significant gains despite today's decline. The question they face is fundamental. Do they view this pullback as a buying opportunity or as a warning signal to exit? Their collective answer will influence price direction significantly. Volatility works in both directions with equal force. The same market dynamics that created today's destruction can fuel equally violent rebounds under different circumstances. Traders who establish short positions into today's decline may need to cover those positions. Bargain hunters with prepared capital may view current prices as attractive entry points. Systematic dip buyers with cash waiting on the sidelines may decide current levels represent value. Ed Yardeni of Yardeni Research offered valuable perspective on the overall rally that preceded this correction. The surprise, he noted, was that gold went from $3,000 to $5,500 without experiencing any significant correction along the way. A correction back to $5,000 with some consolidation around that level would represent a completely normal pattern in a bull market. What we have witnessed, he said, is more of a melt-up than a traditional bull market in precious metals. Melt-ups require periodic shakeouts to become sustainable over longer time frames. Trends that never correct attract the weakest hands and most leveraged speculators. When those participants inevitably exit, the selling pressure becomes overwhelming. Today may represent the healthy shakeout that transforms an unsustainable melt-up into a durable trend. Alternatively, it may represent the beginning of a deeper correction that tests investors' conviction more severely. Only time and subsequent price action will reveal which interpretation proves correct. Professional financial advisors typically recommend keeping precious metals exposure between 10 and 15% of a total portfolio at maximum levels. Overall alternative asset allocation is often capped at approximately 20%. These guidelines exist precisely because trading sessions like today happen periodically. Diversification provides protection against single asset volatility events that can otherwise devastate concentrated portfolios. The key price levels are now clearly established. Support sits at $90 to $95 in the near term, with deeper support at $70 to $80 if selling pressure accelerates beyond current levels. Resistance stands at $110 to $115. A daily closing price above or below these zones will signal where momentum lies and provide guidance for tactical decisions. Geopolitical risks remain elevated across multiple regions simultaneously. Tensions involving Venezuela, Greenland, and Iran continue developing with uncertain outcomes. Dollar weakness over the past year drove significant capital flows into precious metals, as investors sought alternatives to dollar-denominated exposure. These fundamental drivers have not vanished despite today's price action. History suggests violent market moves require time to digest fully. After April 2013's precious metals massacre, markets traded sideways for extended periods before establishing new trends. Expecting immediate resolution or clear direction after today's extraordinary session may prove unrealistic. Patience may prove more valuable than prediction. What remains certain after today's historic session is that silver just experienced its most violent single-day move in 13 years. The magnitude of decline exceeded anything in modern precious metals history on an absolute dollar basis. $20 billion in market value changed hands in a matter of hours. The catalyst combined a Federal Reserve appointment announcement with extreme technical positioning and crowded speculative trades that had become disconnected from underlying fundamentals. The result was price action that will be studied and discussed for years to come. Monitor the key levels carefully. Watch dollar movements for directional clues. Follow the Federal Reserve confirmation story as it develops. Pay attention to industrial demand data as it emerges. Observe central bank behavior for signals about long-term accumulation trends. And remember that markets have demonstrated repeatedly throughout history their ability to confound expectations in both directions with equal conviction. This content is provided for educational and informational purposes only. It does not constitute personalized investment advice. Past performance does not guarantee future results. Always conduct your own thorough research and consider consulting with a qualified financial professional before making any investment decisions. Every investor's situation is unique and requires individual evaluation. The silver market just delivered an unforgettable lesson about the nature of volatility in financial markets. $20 billion moved in hours. Fortunes changed. Convictions were tested. The metal that seemed destined for $200 now trades below $100. What happens next remains unwritten. Watch the levels, follow the flows, stay disciplined, and never forget, in markets, the only certainty is uncertainty itself.